Hey everyone, hopefully you're having a good day. My name's Andy, my channel's Finding Value. If you like making money, if you want to be on the winning team, I don't know, I started adding this winning team in here, so why not? Subscribe to the channel, give me a thumbs up for this content, leave questions below if you guys have any questions. I'm going to go over identifying value and conditions. This is my opinion. This is what I've tied together over the years of investing and how I view the world and the market conditions. So it may go in the face of some other people, but this is the way I see it, and this is the way I approach investing. So identifying value and market conditions. So first, you need to understand the currency. The Fed creates money through open market operations. Basically, they put money into banks. That money becomes bank reserves, and then the bank lends that money out through fractional reserve lending. The majority of the money that's created through fractional reserve banking is that money being loaned from the commercial banks into existence, and it typically goes through the avenue of mortgages. And I'll show you in the next slide here what this looks like through commercial bank lending. The vast majority of money, 97%, comes into existence when a commercial bank extends a loan. And remember, this is a little bit older. They have created a ton of money, and I'm sure this percentage has vastly gone down with the trillions upon trillions upon trillions that they have created. But this is normally what's happened in the past. 27% of the bank lending goes to other financial corporations, 50% to mortgages, and of that 50%, mainly of them are on existing residential property. 8% to high-cost credit, and 15% to non-financial corporates. That is the productive economy. Now, one thing to understand is demographics. Demographics is extremely important. And all I want to point out is the millennials coming in home buying years are right here. See how it kind of balloons out a little bit? This is where the majority of people are. The demographics kind of balloons out there. And that ballooning is going to push real estate prices higher. It's going to be a more inflationary period because demographics typically is tied to home buying if they're in home buying years, and they're going to spend a little more money having kids on diapers and trips and all these different things that they do when they get into their 30s and 40s. That's the peak spending years and peak earning years. So when that demographic comes through, you're going to see higher spending. Identifying value. So real estate, I'm going to identify the cycle. We're going to understand the metrics, days on the market, inventory, foreclosures, deficits, prices. And we're going to look at some ratios. S&P 500 commodities, Dow to gold, gold to oil, and real estate to gold. Those are your ratios, and that's your value. That's how you identify value, is through ratios and through the metrics of real estate. So real estate metrics, the inventory, again, looking at it from today's viewpoint. We have record low inventory. We have very short days on the market, which means inventory is moving very quickly. We've got housing starts, which is barely above the yearly demand, which means we are just entering an expansion phase in real estate, and I'll show you what that looks like. We have foreclosures, which are extremely low, and we've got a demand-supply balance, which is a deficit of 3.5 million homes nationwide, and this is one of the largest deficits I think we've ever had. And remember, we've got that demographic coming of the millennials and home buying years that I just showed you. The yearly demand for new homes is around 1.5 million per year. So this is the supply of new housing. And I want to touch on something here. This is the 1.5-ish red line right here. It's a little high. Now, in 1982, this was a low point for new U.S. homes being built. And whenever you go above this line, this is either a demographic is coming through, which is the baby boomers, and then you go into an expansion phase of real estate, and this is a recession. We came down, and see how this thing is cycling back and forth? And I'll show you what that looks like in the next slide, the actual cycle. But I just want to show you that the new housing starts or new home builds, we underproduced under the 1.5 million for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. For 10 years, we were producing homes far less than the lowest time in the past 50 years. 50 years, and we built 10 years in a row underproducing. This is where the home shortages happened. And the reason this happened is because of all the foreclosures and this hypersupply phase over here. It screwed the housing market up. It screwed it up. And that's why we have such a large deficit in real estate. Now, this is the real estate cycle. I'm just going to go over it real quick. A recovery phase, expansion phase, hypersupply phase, and a recession phase. So you have a recession, goes into recession, and prices fall. We cut back on the housing starts, new homes being built in a recessionary phase. That's what causes this to come down. This is a recession phase, and they cut back. And then it goes into a recovery phase. This is what the recovery phase looks like when it bottoms and starts to recover. And then we go into an expansion phase when it goes above the 1.5. This is an expansion phase here, a recession, a recovery phase, went right back into an expansion phase because of demographics, recession, all the way down into a recovery phase, expansion phase. This was a very quick move here because it was staying above the 1.5 because of demographics. We had a smaller demographic come, we went into hyper supply phase, and then we just got blown out to the downside. This is the housing starts. I overlaid the 1.5 million. I overlaid some red and green circles here. I'm going to tell you on the next slide what that is. But this is the housing starts, recession, recovery phase, expansion, and it just goes over and over as it cycles back and forth. The area under the curve here is our home deficit. We have a major problem in the housing market, and we're just starting to come above the 1.5 here recently into an expansionary phase. Now, these red and green circles, that is the commodity to S&P 500 ratio. Cheap commodities is green, expensive is red. And I overlaid the ratios to this housing, new housing build or home starts. And what you notice is that it starts at a beginning of a recovery phase or an expansion phase and goes up into an expansion phase, the commodity bull market that is. It goes right and aligns perfectly with the home starts. We had this one here, we had this one here, and then we have one starting and throwing a signal of a buy signal, and we're going into an expansion phase of real estate. There's no way that this correlation happens by happenstance. What this is saying is that we have inflationary periods under expansionary phases of real estate, which makes sense. And my thesis is on this channel is that real estate sets the market conditions for investments because inflation comes from real estate, and that inflation has an effect on interest rates, and that interest rates have an effect on all investments. So ultimately, real estate affects all of the other markets, and ultimately you could say that demographics is the driver of all of these things. That is my thesis. So we go into oil price. What I did is I'm overlaying all of these cheap and expensive areas with these, and they correlate very well with the prices, the price moves, and the bottoms are nailed every single time with this, the green buy points and red sell points. Perfect correlation there. This is the oil to gold ratio, green and red buy points here, and sell points. Green means it's cheap, red means it's expensive, then we should be selling. Notice how out of whack this got currently. We've never had an oil to gold ratio. This is the gold's expensive on the top, oil's cheap on the top, and gold is cheap on the bottom, oil is expensive on the bottom. So oil has never been this cheap in relationship to gold in the history of this measurement all the way back till 1861. This was a huge opportunity to invest into oil, a once-in-a-lifetime investment opportunity into oil, with the ratio being this cheap. And again, this is the historical inflation-adjusted uranium price. Notice 72, this popped in like 73 all the way to 76. 70 to 73, 74. So it's just slightly off. It's just delayed offset. We've got 2000 to 2007. And then we've got 98 to 2008. So the bull market of uranium was in this bull market of commodities. So that aligns as well. And if we're aligning right now with a bull market in commodities, I think all these are game on for being good investments. And again, we're at 0.006, which is literally down here. We've never been this cheap. Commodities, that is, in relationship to the Dow Jones ratio. We've never been this cheap. This is 100 years of commodity valuations. We are sitting at the bottom of this chart, signaling that this is the greatest opportunity for investment that anyone's ever had in the past 100 years. This is the Dow to gold ratio to show you that we are coming down. We're at 17. It's popped back up a little bit just above here right now. And that gold is cheap in relationship to Dow. Usually at bottoms, it's 1.3, 1.9. I think we'll get back to 1. So we'll go from 17 to 1, which means gold's going to outperform the Dow. 17, it's going to have to go all the way down to 1, which is a 17 times return. If gold goes up and all the other ones are leveraged, all the other commodities are leveraged to gold, we're going to get massive returns in those commodities. Absolutely massive returns. Now here's the long-term interest rates back to 1790. I think this is driven by demographics. You can see it decline, and we had all these wars where I think we were probably killing and a lot of people were dying, but it came down this cycle. We bottomed at a very low interest rate. We went all the way back up to 14% by 1981. This is long-term interest rates. And then we are coming back down. And when we come back down in interest rates, this has a profound effect on stocks and bonds. It pushes stocks and bonds higher. It's in a very large secular bull market. And I propose that this is going to change, and we're going to go up something like this or something like this. Whatever that looks like, it's going to go up and it's going to change. And that change in interest rates, that secular bull market change, is going to have a profound effect on the investments. And typically, when you have a large move in interest rates to the upside, bonds and stocks underperform while commodities and inflation-protected assets do very well. So you want to be in the inflation stuff like commodities, precious metals, emerging markets, international stuff, because the dollar is going to be weak. Now here's the M2 money supply, and I don't even think I have the most recent stuff, but this is a huge move in the M2 money supply. I think inflation's coming. It's just a matter of time. So the conclusion here is the new builds have a home deficit of 3.5 million. It's going to drive real estate higher, which is going to drive inflation higher. New homes are going to start to go into an expansion phase. In those expansion phases, it aligns very well with commodity booms. Higher prices are going to drive inflation. Commodities will outperform, in my opinion. Gold is a leader and is outperforming stocks. It moved up. We're in a pullback right now of gold. It will continue higher. It's got to. And interest rates are supposed to be held low by Fed and base money being created. That's what they're trying to do. I don't know if they're going to be successful in holding interest rates down. I don't even know where they're going to hold it or where they're going to try to put the brick wall. If it's 2%, 1%, it's right now it's at 1.345, somewhere in there. But they're going to try to hold them down. And what that's going to do is if inflation moves up and they hold interest rates down, it's going to create a very large negative real rate, which is going to fuel all the commodities. I mean, it's going to absolutely be on fire. And these things are going to go much higher than where they are today. In my opinion, potential investments: physical platinum, physical silver, uranium, natural gas and oil producers, copper, nickel, cobalt, lithium, tin. And there's probably more than this. There's fertilizer companies, there's agriculture companies. But those are the ones that are my favorite ones right there. And I think playing all of the sectors is fine. Get a little bit in each because we don't know which one is going to be the best returner. Historically, silver's done very well, oil's done very well, uranium's done extremely well, nickel's done probably one of the better ones as well. But you got to keep in mind that the deficits of some of these materials are so large in the future because of electric vehicles and renewable energy that I think you have to be in almost all of these because you don't know which one's going to hit the deficit and you don't know when things are going to come online perfectly, how much is going to come online, what those deficits will look like, what the demand will do when the prices rise to certain points. I think platinum is a good one too because there's just not much of it, and it's very inelastic. Same with uranium. So these prices can move substantially, and the demand never really tails off because it's used in such trace amounts. Silver is another one too, in such trace amounts in the products, and it doesn't have a large impact to the final cost to the end user. So all of these, I think, are excellent investments. You get a little bit, spread it out, get it in all of them, and just ride it. That's what at least that's what I'm doing. I can't give financial advice. I'm just telling you what I'm doing. Now you see what my paradigm is of how I see these investments. Because I know we got a lot of new subscribers. I'm getting a lot of questions on this, and I'm going to do these updates every once in a while. I know for some subscribers, you've seen it before, but this is for new subscribers, so you kind of get my opinion and my viewpoint on what drives what. And it took me some years to put this together and figure out what drives what, at least in my opinion of what drives inflation, what drives interest rates, what drives the rotation of money, all of those things. This is all from my viewpoint. So if you like this content, guys, subscribe to the channel. Give me a thumbs up. Leave comments below if you disagree or if you think something else is going to happen. Let me know. Thank you for listening. This is Finding Value.